Imagine waking up one morning and turning on the news to hear that the banks are closed. You reach for your phone to check your balance, but the app won't load. There's only a small, annoying loading icon spinning on the screen. Thinking maybe it's an internet issue, you go outside. You see a handwritten note taped to the corner ATM, out of service. Shops are open, but no one wants your bank card. Gas stations have put up cash-only signs. Rent is due, but your landlord won't accept a transfer. At first, you assume this is a technical glitch, a temporary outage. But then you notice the mood in the streets. People are lining up outside shuttered bank branches with angry and fearful eyes. Supermarkets are full of people with carts stacked high, trying to stock up on basic food with the last crumpled banknotes in their pockets, because cards are useless. Breaking news flashes on TV, financial system under emergency review, and suddenly the thought hits you like ice water. Your money isn't where you thought it was. It's not in your account waiting to be withdrawn. It was always just a number on a screen. And now the screen has gone dark. This sounds like the opening of a dystopian novel, doesn't it? But it's not. This has happened before. And not in distant, unstable countries you never think about. It happened in countries that thought themselves modern, safe, and secure. And when this happens, life doesn't slow down politely. It snaps. The rules of wealth and survival change overnight. Welcome to Paper Empire's history. Today we will talk about the financial system's biggest nightmare and who the money you think is yours actually belongs to. Let's begin. If you want historical proof, look at Argentina. The year is 2001. After years of economic mismanagement, unsustainable debt, and IMF bailouts, the government was desperate. Banks were bleeding. Citizens, sensing the approaching danger, were trying to convert their pesos into dollars and move them abroad. So the government slammed the doors shut. They called it El Corralito, meaning the little corral. But for ordinary Argentinians, it was a cage. Cash withdrawals were capped at just 250 pesos a week. Dollar accounts were forcibly converted into devalued pesos at a low rate set by the government. In just weeks, savings accumulated for homes, businesses, or retirement lost half their real value. Middle-class families, people who thought themselves safe and stable, were suddenly thrown into chaos. They rebelled in the streets, banging pots and pans, cacerolazo. This is what happens when banks shut down. Money evaporates not in an abstract sense, but in the way bread, milk, and rent become unaffordable overnight. And Argentina is not alone. Cyprus, 2013. The European Union forced the government to freeze bank deposits as part of a bailout deal. Ordinary depositors woke up one morning to discover that accounts over 100,000 euros would be shaved, literally seized, to rescue failing banks through a method called bail-in. It wasn't the billionaires who felt this most. It was businesses that couldn't pay employees, retirees who couldn't access their pensions, parents who couldn't pay their children's school fees. Lebanon, 2019. Years of corruption and fiscal collapse triggered capital controls. Banks limited withdrawals to a few $100 a month. Savers had to storm branches, not with paperwork, but with guns. And in every case, the story was the same. What you thought was your money turned out to be theirs. Even in the land of it could never happen here, in the United States of America, banks have closed. I know you are surprised, but this is all real. In 1933, at the depths of the Great Depression, President Franklin Roosevelt declared a nationwide bank holiday. The name sounded pleasant, but it was martial law. For 4 days, every single bank in the country locked its doors. Citizens couldn't withdraw cash, businesses couldn't pay wages. Uncertainty reigned. The economy stopped until the government inspected and selectively reopened sound banks. Think about it. One of the wealthiest nations on earth had to literally freeze its entire banking system to prevent collapse. The common thread in all these stories is this. Banks don't hold your money the way you think they do. They operate on a fractional reserve system. This system is both the genius and the Achilles heel of the modern economy. Let's put it simply. Banks don't take your money and store it like a coat at a check room. They take it and multiply it. You deposit $1,000. The bank keeps only $50 or $100 of this as reserves in the vault. It lends the rest to a business, a home buyer, or the government. That loan becomes someone else's deposit when spent, and that bank lends the money out again. A cycle of money created out of thin air. $1,000 turns into $10,000 of credit volume in the system. This is a machine that ignites growth, but it is also a house of cards. Because if too many people ask for their money at the same time, bank run, that money is physically not in the bank. That is why confidence is everything. The system works as long as people believe the doors will stay open. But the moment that confidence is shaken, even for a second, the stampede begins. Not everyone needs to ask for their money, just enough people to expose how thin the reserves are. And when panic spreads, even solvent banks can collapse. It is like a fire in a crowded theater. One scream, a rush for the exit, and the struggle for survival turns into a stampede. Governments know this. That is why, in a crisis, their instinct is to protect the banks, not the individual saver. When Argentina imposed the corralito, or Cyprus, seized deposits, it wasn't a mistake. It was a conscious choice to prevent the system from collapsing. The ordinary citizen was forced to finance the mistakes of politicians and bankers. Roosevelt wasn't just calming the public in 1933. He was buying time to break the chain of failure. But what is truly terrifying is that this history is just the beginning, because modern laws have already determined what will happen to your money in the next crisis. And these rules were not written in your favor. The truth is, banks and governments are joined at the hip. They never separate. They are in a symbiotic relationship. Banks need governments to establish confidence and rescue them in crises. Backstop. Governments need banks to buy their bonds, finance budget deficits, and pump credit into the economy. When systemic stress hits, they close ranks, and the person left outside is you, the depositor, the taxpayer, and the supposed owner of your money. This exclusion is masked by rules and insurance schemes. For example, institutions like the FDIC in America guarantee deposits up to a certain limit, $250,000 in the US. This sounds like protection, but ask yourself a simple math question. If every depositor in the country demanded this guarantee at the same time, would there be enough money in the funds? The answer is a definitive no. Insurance funds can cover only a tiny fraction, 1 to 2% of total deposits. The real power of these funds is not financial, it is psychological. It is a placebo designed to keep you calm, to prevent panic. It works if a small bank fails. But in a systemic collapse like 2008, the insurance fund evaporates in minutes. So what does life look like in the modern world when banks close, commerce stops, digital payments evaporate, salaries aren't deposited, supply chains lock up? In Lebanon, factories couldn't import raw materials because they were banned from sending dollars abroad, capital controls. During the 2015 crisis in Greece, people waited for hours in the scorching heat at ATM queues just to withdraw a mere 60 euros a day. Weddings were postponed, surgeries couldn't be performed, children were taken out of school. Why? Because the financial system had decided that access to money was not a right, but a privilege to be rationed. Even in the age of smartphones, crypto exchanges, and fintech apps, this problem hasn't been solved. On the contrary, it has deepened. The digitalization of money has made us more dependent than ever on centralized systems. If the server crashes, if there is a cyber attack, or if the institution freezes your account due to a suspicious transaction, your wealth consists merely of numbers in limbo. A cashless society isn't a utopia, it's a trap. In a world without physical cash, the concept of a bank shutdown isn't a dusty memory from the Great Depression. It is a modern nightmare waiting to happen, a digital cage with nowhere to run. Think of the ripple effect. Businesses can't pay workers, layoffs begin. Supermarkets can't pay suppliers, shelves empty. Investors panic, selling assets at fire sale prices. Pension funds melt. The government tries to restore confidence, but as the queues grow longer, patience runs out. A technical liquidity decision taken in a boardroom descends onto the street as a full-blown social crisis. Barter economy begins, hoarding increases, even looting starts. This isn't theoretical. It happened all over the world. And if you think this is America, this is Germany, this is safe, remember, Argentinians in 2000 and Greeks in 2010 said the exact same thing. Stability is an illusion that exists until the day it doesn't.
Here we must talk about a legal truth that most people don't know. The disturbing truth is this. Banks do not exist primarily to protect your wealth. They exist to protect themselves and the system they serve. When stress comes, they sacrifice you to survive. After the 2008 crisis, G20 countries and financial authorities quietly changed the laws. Previously, when banks failed, the state would rescue them with taxpayers' money, bailout. The public rebelled against this, so a new mechanism was introduced, bail-in. Legitimized by the Dodd-Frank Act in the US and BRRD regulations in Europe, this rule says, if a bank reaches the point of failure, instead of being rescued by state money, the assets of the bank's own creditors, that is, depositors, can be seized to recapitalize it. Legally, when you deposit money in a bank, you are not the owner of that money. You become an unsecured creditor of the bank. If the bank fails, you get paid last, after derivatives creditors, or you don't get paid at all. This is what happened in Cyprus in 2013. Depositors' money was seized, and in return, they were given worthless shares of the failed bank. This wasn't a robbery, it was a legal procedure. So, what can you do in the face of this scenario? Is the answer to panic, withdraw money, and hide it under the mattress? History shows that reactionary fear makes you more vulnerable. The real strategy is resilience. Diversification is not a buzzword. It is a matter of survival. Holding assets in more than one form, in more than one institution, even in more than one country, jurisdictional diversification, makes the difference between being paralyzed and having mobility. Real wealth is not just the numbers you earn. It is what you can truly access in a crisis. Physical assets. Assets like gold and silver that have no counterparty risk. Real estate. Tangible value that stands outside the banking system. Self-custody. Assets under your own control, independent of banks, like crypto assets in a hardware wallet. Cash reserve, the only liquidity that continues to work when digital systems collapse. These are not old-fashioned ideas. They are lifelines. We must also understand collectively, laws are written to protect the system, not you. Capital controls, emergency powers, withdrawal limits. These are tools to manage panic, not to prevent collapse. The most terrifying part of the story is how fragile confidence is. Banks don't need to physically collapse. People just need to stop believing. The moment that belief cracks, the countdown begins. And when the shutdown is declared, the mask falls. Banks were never neutral service providers. They are power structures deeply tied to governments, corporations, and global markets. You are not a client. You are a participant in a system that works as long as it works. History doesn't repeat exactly, but its echoes are loud. From Argentina to Cyprus, from Lebanon to Greece and America, the lesson is simple. Do not confuse access with ownership. If your wealth depends solely on the mercy of institutions, then it is not truly yours. You only have usage rights. To build financial freedom, you must look past the illusion of security and prepare for the moments when the system falters. Because one day, the question might not be, what happens if banks close tomorrow? But, they closed. What do I do now? For those who are prepared, this represents a turn in the road. For those who are not, it is the end of everything.
If what I shared today helped you see the world from a different perspective, don't forget to subscribe. History always has an answer. You just need to look from the right angle. And I am here to help you find those answers buried in the dusty pages of financial history.